Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following her work for years. She also did an excellent interview on Wealthion. I highly recommend going and listening to it. She is an award-winning, Pulitzer Prize award-winning, my first time ever interviewing one here on the podcast back in 2002. In the past, she worked for the Wall Street Journal. She also had a, I think, weekly Market Watch column, excuse me, and she is currently an NBC News investigative unit reporter. She's here today to talk about her new book, These Are the Plunderers, about private equity, how private equity runs and wrecks America. Gretchen Morgenson, thank you for joining me.
Thank you, Jason. I'm delighted to be with you.
So, Gretchen, we're recording this interview on Tuesday, September 19th, 2023. Before we start talking about some of the details in your book about the Carlyle Group and maybe Mitt Romney and Jerome Powell and some of the other things that private equity has been up to the last couple of decades, what is private equity?
Well, Jason, private equity is what we used to call leveraged buyouts. The corporate raiders back in the 1980s, I think the big deal that everybody thinks of in this realm is the RJR Nabisco deal, which really was KKR's sort of seminal, Kohlberg, Kravis, and Roberts, a very big private equity firm. Their seminal deal was the RJR Nabisco acquisition. So private equity is kind of a new, very Tony name for leveraged buyouts. What these firms do is they acquire companies, they load them up with debt to make the acquisition. They say that they're going to streamline the company, make it more efficient, and then they hope to sell it at a profit within 5 to 7 year time frame. So this is a churn process. This is not a long-term investment process. It's not like Warren Buffett buying companies to hold for decades on end. This is a let's buy a company, see if we can, quote unquote, improve it, and then flip it down the road. Now, there are two basic problems with this concept. One is what I call them are the pressure points in the business model. The first one is the debt. We're talking about private equity firms that use an enormous amount of debt to make these acquisitions. And when you load the debt onto the company you're acquiring, you're basically increasing the costs of that company's operations, right? Because now they have to pay interest expense. Now they have to pay off that debt at some point in time. So that's the first pressure point in the business model of private equity. The second pressure point is this 5 to 7 year short-term time frame where you've got to make the company look better, look profitable, look appealing to another acquirer in 5 to 7 years. That is a thing. That's a concept that requires you to, in many cases, fire a lot of people, strip assets from the company. It requires other kinds of activities that really don't benefit the company over that period. So those are the two pressure points in what is the private equity model, also known as the leveraged buyout model.
Okay, so the phrase private equity, then, it's kind of a marketing job. They painted over the people who are from a prior generation, the leveraged buyout, which has negative connotation. So it's labeled private equity instead, but it's basically the similar types of stuff with very sophisticated finance, and it's short-term oriented, and they're using a lot of debt, and they're going in there and they're trying to do sophisticated things like leverage up the balance sheet, sell off assets. Is management by asset stripping? Would a good case example, a case study, would it be like what happened with Toys R Us, where the private equity bought Toys R Us, which many of our listeners would be familiar with because many of my listeners are a little bit older, and they bought Toys R Us and they took it private, and then they loaded the balance sheet with debt, and they started closing stores and they started stripping assets. And I think the people who owned the private equity, they were paying themselves like insane amounts of money out of Toys R Us, and then Toys R Us was bankrupt and they had almost no assets and no stores within a couple of years.
Well, the interesting thing about Toys R Us, now that was a KKR deal, as you know, Jason, and KKR maintains that they lost money in Toys R Us when that went bankrupt. So it's now, they also made a lot of money on fees, on the kinds of money extraction, I call it, that a private equity firm takes out of the companies that they acquire. But, I would use as a better example, what happens often is they'll buy a company that has a lot of real estate, for example, under it, okay? And like a nursing home company, for instance. And this is a great example in the book of Manor Care, which was a very well-run nationwide nursing home company that was acquired by Carlyle, I believe in around 2007. Just don't quote me on that. But anyway, so Carlyle bought Manor Care. Manor Care was very attractive because it had higher paying customers, and it also owned all the real estate that its nursing homes sat on. Okay, so they did not have to pay rents. They were owned outright. And so what Carlyle did, and this is a classic case of the asset stripping that we're talking about, what Carlyle did was they came in and they took over the company and they sold the land, the real estate, the properties underneath the nursing homes. And that way they immediately got all of their money out. And this was like within 2 or 3 years, a very short time frame. Now that left Manor Care with an enormous expense for rent. And so suddenly the company had really high cost rents that it was now paying to the company that bought the real estate from Carlyle. Carlyle didn't care because Carlyle got the money out that it wanted. But Manor Care had to pay rents. And from that moment on, the company was doomed. And it ultimately filed for bankruptcy. And so that's the kind of asset stripping that we're talking about. There are also, they actually extract money from these companies by loading them with debt. We have a really great example of an aluminum smelter in Missouri that Apollo took over. And they bought the company. They added a huge amount of debt to its balance sheet and then took cash money out from the debt that the company raised, so that they, Apollo, had really made all their money back within a very, very short time frame, less than a year. That also left Noranda, it was called, the smelter, struggling to pay the interest expense on that debt. And Noranda ultimately also filed for bankruptcy. So there are a lot of ways that these firms can extract money from these operations so that they're free and clear. They have made their money back. They don't really have a horse in the race anymore. And so that's the kinds of things that we're talking about that are very damaging ultimately to the acquired company.
So, Gretchen, the examples you've described, it sounds like the private equity companies have its rent seeking and they've destroyed the business models of these underlying businesses. They've caused employees to get fired. The businesses are not operationally, so the customers are unhappy. But the private equity guys, in a very short amount of time, have made immense wealth with, I guess, artificially cheap debt. Now, are they paying taxes on it? Because I know the private equity people, they love, I guess, paying for lobbyists for both political parties. For many years now, they've talked about the carried interest loophole. Is this something that private equity gets away with so they don't pay any taxes?
Well, it's not that they don't pay any taxes, Jason. Here's how it works. They are paying a much lower tax rate on the gains, the income that they receive from their investments in the firms. And so you have Steve Schwarzman, who's a billionaire many, many, many times over. You have Leon Black, also a billionaire at Apollo. You have David Rubenstein at Carlyle. All of these extremely wealthy men pay much lower taxes on the income that they receive because it is considered a capital gain, not income. And this is a trick that has been around for a long, long time. And it's really created these billionaires. Private equity is a billionaire creation machine, one analyst calls it. And it's really true because they end up paying like 21% or 23% of their income in taxes versus the highest rate, which would be 37% right now. So you can see the difference and you can see what that would do. So a person like me or a person like you, we might pay in the 30% range, 37% if we're lucky and have a great year. These guys have fantastic years and they pay in the 20% range. So it's very unfair. Every time anyone talks about rolling this loophole or closing the loophole, you get an absolute deluge of lobbying money, all thrown around Washington to make sure that the loophole remains. And so Obama tried to change this. Biden tried to change it. It never gets done because the money is so huge in lobbying against it that it's practically guaranteed to remain in place. But if you changed that, you would change so much of the dynamic that it would really have an impact on the business model, on these people, on their bottom lines. And so it's unfortunate that we can't get that done.
I remember 10 years ago when I was working my day job as an investment analyst at a newsletter company, and one of my coworkers who had been there longer than me, he was adamant that the carried interest loophole was going to go away. And I was like, I don't think so. I mean, this is big money here. Carlyle Group's in DC. They're paying for lobbying for both political parties. There's big name people that are private equity guys on both sides of the aisle. So this isn't one party or the other. There's big private equity money contributing to both political parties. A lot of people aren't aware of the backgrounds of some of these people that are in politics that came from private equity. Mitt Romney made a lot of his fortune from private equity.
Right. Yeah, it's really the last time. It's interesting. So when Biden tried to change this, or when Congress was talking about it in the during the Biden administration, it was really close. But Kyrsten Sinema was the person that stood up and said, "No, I'm not going to vote for this." And I think she got something like $1.5 million from private equity, contributions to her campaign. So it really is pretty stark, and it's very unfair, of course, that these wealthy individuals who are really not creating much value for anyone except for themselves. The thing that's so fascinating now, Jason, is that the returns on private equity are reverting to the mean, meaning that they're starting to the outsized returns, or the alpha, right, that these funds and firms used to create is really no longer there. It's becoming like the returns are like an S&P 500 fund, which you can buy for 6 basis points. And so the returns are really not as good as they used to be. And so here you have a scenario where these people are really creating wealth for themselves and for very few other people.
Yeah, I would agree, because the employees are losing their jobs, and the customers who are buying these products, whether it was the aluminum smelter, the customers who are buying from them, or Toys R Us, all these customers are not getting any of the stuff. So it's just creating mess with the supply chain. But the people at the top who are getting, I would say, this artificially cheap debt from the Federal Reserve Bank or Wall Street banks or wherever the capital was coming from. And actually, I wanted to ask you that for my next question. One of the main rules for journalism, and I know you're probably one of the top ones that's worked on Wall Street for decades now, is follow the money. So where are the funds from private equity coming from for them to do these deals the last couple decades?
Excellent question, Jason. And this is really the crux of the matter. And that is, these firms need this oxygen to exist. And the oxygen comes from vast, huge public pension funds, endowments, institutional investors. So you have the CalPERS of the world, California Public Employees Retirement System. You have state teachers funds. You have police and fire. You have New York State Common Retirement Fund. All of these enormous pensions who have huge obligations to their former workers who are, going to be retiring or already are retired. You have enormous obligations, and these funds, they invest with private equity in the hopes of being able to meet those obligations. But private equity is very costly. The expenses are high. It's also opaque. You can't really know what you're in, and you have a very long time frame. You have no liquidity. You can't get out of these things quickly. So there are a lot of costs associated with investing in private equity, but the major pension funds have gone all in on it, and they are really the reason these firms exist. Now, are they going to start to think twice about it now that the returns are falling down to sort of the S&P 500 level? Now that S&P is doing great, right? I'm not saying that's bad, but if you're not generating alpha, if you're not generating a much higher return for all the risk, for all the illiquidity, for all the opacity in private equity, then you would hope that pension fund managers would say, whoa, wait a minute, this is not the right place for me to be.
So you wouldn't say then that a lot of the funds the last 15 years were coming from the Federal Reserve Bank thanks to their almost zero interest rate policy that these private equity guys. So if you're almost a billionaire or billionaire, then and you have all this assets to post as collateral, you couldn't go to a Wall Street bank, which had artificially cheap capital too because of the Fed's policy, and borrow extra cheap debt and do these private equity deals?
Oh no, you're absolutely right. The money to fuel the acquisitions that these firms are making came from the Federal Reserve zero interest rate environment, easy money. Absolutely. This would never have happened to the degree it happened if we did not have the zero interest rate policy of the Federal Reserve. They made money so easily accessible, and it was, the world was awash in cheap debt. Okay. So you could go into the capital markets and raise enormous amounts of debt money at very low cost because interest rates were so low. All right. Yes, that is what created the ability for these companies to make the acquisitions. But what I was talking about were the pension funds are who buy their funds. They're the ones who buy the, Apollo fund, the Carlyle fund, the KKR fund. The funds hold the companies that they acquire, and the pension funds invest in them. So they're creating the market. They're the investors that the private equity firms are appealing to, and they would not have a business. Private equity would not have a business model if the pension funds stopped investing with them.
Yeah, I agree. And one of the most egregious examples of pension fund misallocation, private equity, and then adding in the Fed zero interest rate policy was the shale oil bubble. So you had record amounts of production increases for U.S. oil and natural gas production. I don't think it had been seen in over 100 years, but the majority of the production growth, it was done unprofitably. So a lot of the investors didn't make money, but guess who did, Gretchen? It was the private equity guys.
Yes, exactly. Jason, one of the questions you asked a bit ago was interesting about the customers. A lot of people talk about, well, the employees get hurt when they're, fired or they're downsized or the pension is stripped. A lot of times these companies, private equity will buy a company that has a pension and they'll, strip the pension. But the customers are a very interesting question here. So private equity, as you know, is very kind of stealthy. They don't put their names out there a lot. You don't see the Blackstone retailer, or you don't see the Carlisle name on the Manor Care nursing homes. You don't see the Apollo name on the hospitals that it owns. And there's interesting question in my mind about this. Is it because they prefer to operate in the background, but the customers don't know that this is a private equity owned company? But customers are truly, as you pointed out, truly hurt by the activities that these companies do and the way that they strip the assets and fire the workers and cut the costs and, cut corners, essentially. There's one particular academic study that is just devastating about nursing homes, which showed that over a period of time, the nursing homes that were owned by private equity had 10% greater mortality rates than those owned by other entities, even other for-profit companies. So you had private equity firms owning nursing homes that had 10% greater deaths than other owners. That was so damning and so, and it was irrefutable. I asked the companies for their comment on this, and nobody was able to, cast any doubt on the research. It was, really, really top flight academics from NYU, University of Chicago, Penn. Anyhow, 10% greater deaths. It was like 20,000 people died in these nursing homes. And so you really have to wonder about a business model that creates kind of what I call the circle of pain. It creates pain for the workers. It obviously creates bad outcomes for the customers, for the pensioners. If it goes bankrupt, they're left high and dry. Suppliers even, probably. You've got this 360-degree circle of pain, and yet you have these small group of very elite men, generally, who make out like bandits on this business model. And it's just unsustainable, in my view. It really just feels to me as unsustainable as some of the other, business practices that well and that the world has acknowledged are unsustainable.
Well, especially with interest rates this high and the Fed not giving the punch bowl with artificially cheap capital. But like you said, you said a circular, all that problems, but I would call it more like an arsonist business model. They're not providing any value added. They're not improving the underlying business. They're not making smart investments to create new products or services or efficiencies. It's just about the owners who put the capital in. It's kind of a scorched earth policy. I think the economic term is rent seeking, though.
Yes, absolutely. Absolutely. But you're right. It's scorched earth. I also call it the I, me, mine type of capitalism, right? So, there's been for, decades, this idea that if you satisfy the shareholders, if you work on behalf of the shareholders, then everything else is okay. And that's the way we're going to operate. And I hope we're trying to get to a new level of possibly thinking that maybe we should think about other stakeholders as well, not just the shareholders, right? But in private equity's case, they really are in a class by themselves because of what you describe as the scorched earth practices. And so the idea that you would have other stakeholders be harmed by these activities really should, I think, call attention to it. And that's one of the reasons why we wanted to really write the book and hope to shine a light on it so that people could say, wait a minute, do we really want to kind of reward this kind of behavior by, making billionaires out of the people that do it? while they meanwhile, leave workers and customers and pensioners at the side of the road.
Well, it's kind of a trail of bodies they've left. Well, not actually, well, in at the retirement home, but I mean, not to be morbid or anything, but I mean, like they've left like a lot of people there holding the bag while the couple small percentage of people just have enormous profits. I mean, in terms of investment returns, the shale oil bubble, I think in terms of size for private equity is the largest one. I think over $1 trillion of capital was committed to the shale oil production growth for oil and natural gas. And the majority of investors where that capital was invested from 2008 to around 2019. I mean, a lot of those shale oil companies, the shares went up initially and then they collapsed. A lot of the debt had to be restructured or went bankrupt. So there was a lot of losses across the board there, mostly from pension funds. But the private equity ones were the ones who structured the deal. And I'm sure they didn't have the losses.
Well, it's interesting. Yeah, their customers may have. The other thing I'm sure you're aware of, Jason, that they do in the, in as far as in the energy space, is these private equity firms, because they're so short-term oriented, they are willing to buy, companies that are really kind of environmentally unfriendly. They're willing to take off of the hands of, larger corporations who, are starting to say to themselves, maybe we'll jettison some of these activities or these companies that foul the atmosphere or foul the earth, et cetera. But private equity is willing to step in and buy coal companies, for example, because they only have a 5 to 7 year time frame. And so they will, go forward with these kinds of polluting companies and operations. They won't really take the long view and say, let's not, pollute the environment. They're willing to go in and buy these things that other companies want to get rid of for environmental reasons. And that's a really interesting dichotomy, I think, that I'm sure you're aware of.
Well, Carl Icahn also owns an oil refinery. That was initially private equity, but I think it's publicly traded now, or it's structured similarly to a private equity now.
I see.
But I actually wanted to spend a good amount of time on the Carlyle Group. So would you say, because they're literally headquartered in Washington, D.C., that the Carlyle Group is one of the most powerful, if not the most powerful, private equity group?
Carlyle Group is very powerful. I would say that Blackstone is probably the most prestigious, but Carlyle absolutely right up there. And their location and headquarters in Washington is very interesting. And they have actually, made it kind of a practice of having politicians kind of stop there as a way station, either before or after, they work in, Washington for the government. But yes, they are very powerful. Jay Powell was an executive at Carlyle. Of course, David Rubenstein was the founder of the company, and now he's sort of semi-retired maybe, but he goes around buying, up copies of the Constitution, copies of the Declaration of Independence. He paid money to the government to help shore up the Washington Monument when it was having difficulties or about to, there were some problems with the structure. So, and he calls himself, I think he calls himself a, what is it? It's a philanthropist. Well, he certainly calls himself a philanthropist, but he likes to identify with, the history of the United States and, the founding fathers. He owns a copy of the Magna Carta, for example. And so it's just fascinating to see how you could, take a company like Manor Care, the nursing home company, into bankruptcy, and still, kind of maintain this relationship, but maintain these relationships with powerful people and also maintain your reputation. I mean, David Rubenstein has a radio show or a TV interview show. He's very well known and respected, and it's just fascinating to me to watch.
While you were doing research for this book, did you happen to dig into with some research or investigate in any of the deals that Jerome Powell was involved in when he was working at Carlyle Group? So for our listeners out there, they don't really talk about his background too much. A lot of people know he was a lawyer and he's worked at the Federal Reserve Bank for, I think, 7 or 8 years, something like that. Maybe 2012, I think he went on the board of governors. But his background, I think, he was an investment banker, he was a lawyer, but he also started off at Carlyle Group and he built their bond business. And then he was doing private equity deals for at least a decade. And he got all the way promoted up to senior director at Carlyle Group for at least 10 years.
He was, I don't think it was 10 years quite. He was there, but yes, he was at very high levels. I think the kinds of deals that he was doing were sort of, manufacturing. They were, not the kind of glamorous businesses. I'm trying to remember. There was, I think, there was a Hawaii telecom deal that I think he was working on. But in any case, the key that I thought was really interesting about Jerome Powell and about that linked him to private equity when he was the Federal Reserve chairman is that when COVID struck in early 2020, and when the markets were in a tailspin because nobody knew what was going to happen, the economy was shutting down, we were going to have to, sit in our houses, we couldn't go to work anymore. Everybody was in absolute, despair. And what are we going to do? Markets collapsing. One of the very extraordinary things that the Federal Reserve did to shore up the markets, to bolster confidence in the markets, was to act as a backstop for the corporate bond market. Now, Jason, because you're a market historian, that had never happened before. The Federal Reserve has bought mortgage securities. It has certainly done treasuries, government bonds, etc. It has never provided a backstop for the corporate bond market. But to me, that was very telling because Jerome Powell comes from private equity. The corporate bond market is the lifeblood of private equity. They cannot live without the corporate bond market. And if the corporate bond market was going to be in free fall, then that was going to hurt the private equity industry. And so the fact that the Fed did this unprecedented backstop of the corporate bond market was very telling to me in 2020.
Well, I think the rules have been constantly changing since 2008, 2009. I know you also put out a great book about that as well. But I think really since 2008, 2009, there's just been an insane amount of bailouts, stuff behind the scenes that we may not know about. I know there was a one-time partial audit in 2011 that both political parties actually agreed on for the Federal Reserve Bank. But it just seems that the rules are constantly changing. There's lots of bailouts and the goalposts are being moved. And what you just said there with Jerome Powell and private equity and corporate bond market bailout, it doesn't surprise me anymore because it fits right in with that, what I call stagflate tax lie and the rules changing.
Yeah. No, I mean, talk about bailouts, the bigger you are, the more, likely it is that the government's going to say, oh, we got to help you. You're going to disrupt the financial system if you go down. And, it makes no difference whether or not you were, doing the right thing, doing the wrong thing. We've got to bail you out because you're a systemically important institution and you might wreck the financial system. So, you get a bailout, you get a pass.
Well, do you think then that they're going to label that for commercial real estate companies or pension funds or insurance companies that are sitting on these bond losses and commercial real estate losses that are coming in the next couple of years?
I think so, Jason. I think what we're going to see is a really kind of bad situation in the insurance industry. As you know, private equity has been going full force into insurance. Apollo bought Athene. Athene has been buying up pension liabilities. They bought the pension liabilities of Bristol Myers, Coors, Lockheed Martin. They bought up tremendous numbers of pension obligations. Now, what that means for those people who own those, who have those pensions, they are no longer backed by the PBGC, the Pension Benefit Guaranty Corporation, which is the government. They are now backed by Athene, an Apollo global management company. The other private equity firms have also gotten into insurance. I think that that is where we are going to see the next hiccup come if we continue to have the high interest rates and the defaults that we're going to start seeing in the corporate bond market because of the interest rates.
Yeah, there were rumors a couple months ago that Florida, the governor of Florida and other people in his administration were covering up some insurance companies in Florida that had failed that were already insolvent. So I haven't seen mainstream journalists confirm that or not, but there are rumors going around Twitter from some non-mainstream journalists that this had been the case. They had been leaked the information. So you would say then in terms of industries that private equity is actually for the near future is targeting the insurance industry, or there are other industries that private equity is allocating more capital to?
Well, insurance for sure, but also healthcare. As you know, they have been really going full strength into healthcare. As of now, roughly 40% of emergency departments in the United States of America are overseen, run, managed by private equity firms. They won't advertise it. You don't see it when you walk into the hospital, but they're there. And they're creating problems. So healthcare has been an enormous investment for private equity because, of course, it's, 18% of gross domestic product. So that's a big pot of money. And there are a lot of, Medicare payments, et cetera. So healthcare is huge, huge. And you're really starting to see problems. Blackstone, company that they owned, which was an autism services provider, just filed for bankruptcy in June or May. You also had Envision, which was a hospital staffing company owned by KKR. It filed for bankruptcy earlier this year. So you're starting to see the tremors in some of these arenas where private equity really went whole hog on, like healthcare.
So what can we do, the average person on Main Street, then, to try to make awareness or get our congressmen to stop private equity from getting these tax advantages and, destroying these businesses that we need every day?
That's a really good question, Jason. Very, very perplexing. Like I said earlier, these companies don't advertise that they are in your life, but, you have no idea how often you are basically shopping at a private equity owned company, going to a private equity owned healthcare provider, your child going to a pre-K program. I mean, it's really, they're everywhere. They're everywhere. And so the first thing you should do, I think, one thing you can do is ask if your dentist, ask if your doctor is owned by private equity. Ask if your dermatologist is owned by private equity, because have been so many acquisitions of physician practices, anesthesiologists. It's very, very difficult to unpack all of this, but you can ask your veterinarian, your dentist, if they are owned by private equity. And if they are, you might want to think about shopping somewhere else, because they will be in the business of, quote, streamlining, which might mean cutting corners.
Or it's overbilling. I mean, like, I went to a specialist and I saw the doctor for 2 minutes, and it looked like all these other things on the insurance billing were buttons were pushed for all these extra charges, and it was $250. So it seems like private equity guys maybe, obviously doesn't have to be private equity for that. Our healthcare insurance industry is a mess. Our healthcare and healthcare insurance are both a mess. But you think when did private equity actually get involved in this and in buying these doctors' offices and stuff?
It started basically in like 2006, really. So they've been at it for a while. But, if you look at dermatology, they go into the practices that are the most lucrative: anesthesiology, staffing, dermatology. So it's really been, and finally, Jason, the FTC is starting to take notice, and they're trying to look at some of these roll-ups of these industries and make sure that it's not anti-competitive, because in fact, it is anti-competitive when they start to get monopolies on, emergency departments, and then they can tell the doctors how to operate, which is really frightening.
That is truly shocking. I mean, like, a lot of these doctors pretend that it's a small little practice, but then my general doctor about 12 months ago, he said he was going to a concierge model and was going to start charging $1,800 a year for concierge medicine on top of the normal healthcare insurance costs and the other copays and stuff. So a concierge model. So maybe that's private equity getting involved, buying up his medical group and trying to maximize profits there, because it didn't seem like they were going to provide any value added for that extra $1,800 a year.
Well, I think what they would argue that the value added is you would be able to get an appointment within within a day or two, rather than waiting 3 months to go to see, your physician. It's crazy. Healthcare is such a mess, like you said.
Well, yeah, a couple Zoom calls for that much money, I don't think is worth the extra funds.
Yeah, exactly.
Well, I want to thank you so much for your time today, Gretchen. I'll put a link to your book. Do you want to promote it on Amazon, or is there another website that you people should go to buy the book?
Amazon is fine. Barnes and Noble, either one is great. Really appreciate your interest, Jason. Thank you so much for having me and for, shedding light on this topic. It's really important.
Well, I'm right here out of Washington, D.C., and I've met a lot of private equity guys at a lot of these financial networking and real estate conventions over the years, and let's just say they're not very pleasant to be around.
All right. Well, I didn't talk to that many of them because they didn't return my calls.
Well, you can come down to D.C. They're at most of the happy hours and charity events and the country clubs.
Okay. All righty. Thanks, Jason.